Silver crashed $14 in 4 hours, December 29th, 2025, 2:47 a.m. CME raised margins again, second time in 1 week. Silver was at $84, then $73.72. Over 67 million ounces liquidated in a single session. This wasn't normal profit taking. This wasn't retail panic. This was forced liquidation, institutional liquidation. The exchange changed the rules mid-rally. They raised the cost to hold positions from $20,000 to $25,000, a 25% increase. While you were sleeping, traders woke up to margin calls, couldn't meet them. Positions closed automatically. The silver rally just got snapped, and they're calling it Silver Thursday 2.0. Purpose. Explain what happened, when it happened, and the immediate market mechanics. I need you to understand exactly what happened here because this is the playbook. This is what they do when silver rallies too hard, too fast. On December 26th, the CME Group issued advisory number 25393. Initial margin requirements for March 2026 silver futures jumped from roughly $20,000 to around $20,500 per contract. That was the first warning shot. Silver was pushing toward all-time highs, trading in the low 80s. The market barely blinked. Traders absorbed it. The rally continued. Then came December 29th, Sunday night into Monday morning. Silver had just touched $84 per ounce, a new all-time record, shattering the 45-year-old peak of $49.95 set back in January 1980. The momentum was extraordinary. Retail was piling in. Social media was on fire. Everyone was talking about triple digits in 2026. The CME issued a second margin hike. This time they raised it to $25,000. That's a 25% total increase in less than 1 week. If you were leveraged, if you were running multiple contracts, if you had stretched your capital to capture this historic rally, you just got hit with a massive cash demand immediately. Here's what happened at 2:47 a.m. Eastern Time. The liquidation started. Traders who couldn't meet the new margin requirements saw their positions automatically closed by their brokers. This wasn't voluntary. This wasn't strategic profit-taking. These were forced sales. And when forced sales hit a leveraged futures market, prices collapse. Silver went from $84 to an intraday low of $73.72, a $10+ drop in hours. Over 67 million ounces of paper silver liquidated in one session. That's not normal volatility. That's a structural break. By December 31st, 2 days later, silver was trading around $71 to $70. The entire December rally had been wiped out. Traders who were up 30%, 40%, 50% on their positions from earlier in the year watched those gains evaporate overnight. Not because fundamentals changed, not because demand collapsed, but because the exchange raised the cost of participation. The CME's official explanation? Risk management. They said volatility had increased. They said margin requirements needed to reflect current market conditions, standard regulatory language. But here's what they didn't say. This is the exact same mechanism they used in 1980 to break the Hunt brothers. It's the same mechanism they used in 2011 when silver hit $49 and they raised margins 5 times in 9 days. The pattern is identical. Silver rallies hard, physical supply gets tight, paper markets start showing stress, exchange steps in, margin hikes, forced liquidation, rally broken, and now it's happened again. At $71, we're sitting right at a critical technical level. The question isn't whether this was manipulation. The question is what happens next. Because the physical shortage didn't go away. The industrial demand didn't disappear. And China's export restrictions just went live on January 1st, 2026. The paper market just flinched, but the physical reality is still there. Purpose. Connect current events to past precedents, specifically 1980 Hunt brothers and 2011 margin hikes. This has happened before, twice, and both times it ended the same way. January 1980. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, had been accumulating physical silver and silver futures for years. They believed inflation was going to destroy the dollar, and they were positioning for it. By late 1979, they controlled an estimated 100 million ounces of physical silver and held massive futures positions. The price went from $6 per ounce in January 1979 to $49.45 by January 18, 1980, a 713% increase. The exchanges panicked. On January 7, 1980, COMEX adopted Silver Rule 7. It drastically raised margin requirements and limited the number of contracts any single entity could hold. The Hunt brothers couldn't meet the new margin calls. They tried to get loans. Banks refused. On March 27, 1980, Silver Thursday, the price collapsed from $21 to below $11 in a single day. The Hunts defaulted. Their empire crumbled. The silver market stayed suppressed for decades. Fast forward to April 2011. Silver had been climbing steadily. driven by monetary policy concerns after the 2008 financial crisis. It hit $49.80 on April 28, 2011, nearly matching the 1980 high. The CME stepped in again. They raised margin requirements 5 times in 9 days. 5 times. Each hike forced more liquidation. By May 2011, silver had crashed to $35. By September, it was below $30. It took another decade before silver even attempted to break $30 again. Now look at December 2025. Silver breaks $84, a true all-time high. The CME raises margins twice in 1 week. The price collapses to $71. The mechanics are identical. Change the rules when the rally threatens to break the system. Here's what makes this time different. In 1980, the Hunt brothers were trying to corner the market artificially. It was a speculative play with leverage. They were accumulating for control, not because of structural supply issues. In 2011, it was monetary policy fear after the financial crisis, real but driven by investor sentiment, not industrial demand. But in 2025, this rally is built on a genuine supply deficit. The Silver Institute reported a 230 million ounce shortfall for 2025 alone. That's the 5th consecutive year of deficits. Industrial demand from solar panels, electric vehicles, AI infrastructure, it's relentless. COMEX registered inventories are down 70% since 2020. London vaults have hit historic lows. The CME can break the paper price with margin hikes. They've done it before. They just did it again. But they can't print physical silver, and that's where this gets dangerous. Purpose. Expose the divergence between paper market manipulation and physical market reality. I'm watching something I've never seen before. The paper price is crashing, but physical premiums are exploding. Let me show you what's happening on the ground. After the December 29th crash, I started checking dealer inventories. JM Bullion completely sold out of American Silver Eagles. The last one sold for $86 per ounce. That's $15 over the spot price that just crashed to $71. SD Bullion, APMEX, Money Metals Exchange, all reporting 3 to 4 week delivery delays on basic silver products. This isn't normal. When spot prices fall, physical premiums should compress. That's how the relationship works. But instead, premiums are widening. The disconnect is massive. Here's why. The paper market, the COMEX futures market, runs on leverage. It's a casino where contracts represent silver that mostly doesn't exist. The estimates vary, but most analysts agree there's anywhere from 100 to 250 ounces of paper silver for every 1 ounce of registered physical silver in COMEX vaults. When the CME raises margins, they're squeezing the leverage players. The paper price moves violently because it's based on credit and margin, not actual metal. But the physical market? Completely different. Physical buyers don't care about margin requirements. They're buying metal. And right now, metal is scarce. Shanghai silver markets have been trading at $77 to $91 per ounce, while COMEX sits at $71 to $80. That's an unprecedented spread. Dubai markets are showing similar premiums. Arbitrage should close these gaps instantly, but it's not happening. Why? Because you can't ship the metal fast enough to meet the demand. The physical tightness is real. COMEX registered silver, the metal that's actually available for delivery, has been draining all year. Deliveries in December were historically elevated, not at the peak levels we saw earlier in 2025, but still far above normal. And here's the kicker. Very little metal is flowing back into the vaults. Once it leaves, it's gone. Industrial buyers are getting nervous. They're locking in supply contracts at elevated prices because they can't afford production shutdowns. Solar panel manufacturers, electronics producers, medical equipment companies, they need silver. It's not optional. They'll pay the premium, so you've got a paper market that's controlled by exchange rules, margin requirements, and leverage limits. And you've got a physical market that's controlled by actual supply and demand. The paper price just got hammered. But try to buy 1,000 ounces of physical silver at spot. You can't. It doesn't exist at that price. This is the definition of a broken market. And the longer this disconnect persists, the more violent the eventual reconciliation will be. Purpose. Detail the specific signals showing market infrastructure under pressure. Let me show you the stress points. These are the indicators that tell you the system is cracking. First, backwardation. The silver futures market has been in backwardation for months. That means near-term contracts are trading at a premium to longer-dated contracts. In a normal market, the opposite happens. Longer-dated contracts trade higher because of storage costs and interest rates. Backwardation signals one thing. Immediate physical demand is overwhelming supply. The market is screaming for metal now, not in 6 months. Second, lease rates. Silver lease rates spiked to multi-year highs in late 2025. When lease rates rise, it means bullion banks and large holders are charging more to lend their silver. Why? because they're worried they won't get it back, or because demand to borrow is extreme. Either way, elevated lease rates signal tightness in the physical lending market. Third, COMEX delivery stress. December 2025 saw elevated delivery requests, not as high as some earlier months, but still historically significant. And here's the critical part. The metal leaving COMEX vaults isn't being replaced. Total COMEX silver inventories, both registered and eligible, have been declining for years. We're down 70% from 2020 levels. That's not a gradual drawdown, that's a structural drain. Fourth, Shanghai premium. The Shanghai silver market has consistently traded $5 to $10 above COMEX for weeks. At times, the premium hit 15 plus. That's insane. Arbitrage should close that gap immediately, but it's not happening because physical delivery logistics can't keep pace. China implemented new export licensing requirements on January 1st, 2026. Only 44 companies are now authorized to export silver. That's going to make the supply situation worse, not better. Fifth, dealer inventories. I mentioned this earlier, but it's worth repeating. Dealers are sold out. Delivery times have extended from days to weeks, and when supply does hit the market, it's at massive premiums. This is retail-level evidence, but it confirms what the wholesale markets are showing. These aren't isolated incidents. These are system-wide stress signals, and they're all pointing in the same direction. The physical silver market is breaking under the weight of structural demand, while the paper market tries to suppress the price with regulatory intervention. Something has to give. Either physical supply catches up, which seems impossible given mine production timelines, or the paper price will eventually have to reflect physical reality. Purpose. Highlight suspicious institutional actions and incentives behind price suppression. Let's talk about who benefits from this crash, because that's the question nobody wants to ask publicly. The CME Group operates COMEX. They make money on transaction volume and clearing fees. Volatile markets are good for business up to a point. But uncontrolled volatility, especially sharp upside moves in leveraged commodity markets, creates risk for the clearinghouse. If major participants can't meet margin calls and default, the CME is on the hook. So when silver goes parabolic, the CME has a direct financial incentive to slow it down. But there's another layer. The bullion banks, JP Morgan, HSBC, Scotia Makata when they were active, and others, hold massive short positions in silver futures. These positions are ostensibly for hedging their physical inventory and client exposure. But the size of these positions has been questioned for years. If silver rallies too hard, too fast, those short positions create catastrophic losses. There were rumors, unconfirmed but widely discussed, that a systemically important U.S. bank faced a liquidation event around the time of the December crash. The whispers suggested a major margin call on silver futures at 2:47 a.m., requiring Federal Reserve intervention to prevent contagion. I can't verify this. No official confirmation exists. But the timing lines up perfectly with the crash. Here's what we know for certain. Margin hikes disproportionately hurt the long side. If you're long silver, you have to post more cash. If you're short silver, the margin increase might actually relieve pressure because it forces longs to liquidate, driving the price down and reducing your mark-to-market losses. The CME's margin hikes in 1980 broke the Hunt brothers. The 2011 hikes killed that rally. And now the December 2025 hikes snapped this rally right at the all-time high. If this were random risk management, the timing wouldn't be so consistently perfect. But it's not random. It's a tool, and it gets deployed every time silver threatens to break free. Purpose. Present likely scenarios and critical levels to watch without giving financial advice. So where does this go from here? Short term, silver is likely to consolidate between $65 and $75. The forced liquidations need to clear. Weak hands are out. Margin requirements are now elevated, so the leverage that fueled the blow-off top is gone. We could see sideways price action for weeks, possibly months. But the structural forces haven't changed. The supply deficit is still there. Industrial demand isn't going away. Solar installations are accelerating, EV production is ramping, AI server demand is growing. All of these require silver. China's export restrictions just took effect on January 1st. That removes supply from the global market. Elon Musk even commented publicly, saying the restrictions are not good because silver is needed in many industrial processes. Medium term, I'm watching $65 as critical support. If silver breaks below $65 and stays there, it suggests the rally is over and we're entering a longer correction. But if $65 holds and physical premiums stay elevated, that's bullish. It means the paper sell-off didn't reflect physical reality. Long term, this setup is explosive. Every time they suppress the paper price while physical supply tightens, they're creating a larger dislocation. Eventually, either COMEX will face a delivery default, where they can't provide physical metal for contracts demanding delivery, or the price will have to spike violently to reflect actual scarcity. I don't know when that happens. It could be months, it could be years. But the direction is clear. The system is under stress, and stress breaks. Purpose: reinforce urgency, reiterate the core message, create lasting unease. They broke the rally at $71, forced liquidation, margin hikes. Same playbook as 1980, same playbook as 2011. The paper price collapsed. But physical silver is sold out at $86. That's not normal. That's not a functioning market. That's a system trying to hold itself together with duct tape and regulatory tools. COMEX inventories are down 70%. Shanghai is trading $10, $15 over New York. Dealers have 3 to 4 week delays. China just restricted exports. Industrial demand is relentless. They can change the margin requirements. They can force liquidations. They can break paper rallies, but they cannot print physical silver. And that's the problem they can't solve. Silver Thursday happened again. The rally got snapped. But the shortage didn't disappear. It's still there, getting worse. And eventually, reality always wins. Watch what happens next.